Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows primarily for, at least in the first part, primarily for the conventional fund business. We'll get to ETFs intermittently as we go for the week ended May 14th, 2014. We actually had a continuation of the meltdown in the biotech industry, at least for the first part of the week when we're doing Wednesday to Wednesday flows. But actually, as we moved on later into the week, we saw that the S&P 500 and the Dow actually hit all new time highs again. And, by the way, the NASDAQ actually reported one of its best days this week in over 3 months. So certainly it was actually a pretty good week as far as flows goes. We saw about $5.4 billion entered the fund business. And again, this is the conventional fund business ex ETFs. And it was really on some pretty good news. First of all, we heard that there was a new sentiment indicator. This is for the small business sentiment. Basically, was at a 6-year high. So that was some good news as well. And then we heard that China came out with some market reforms that people thought would maybe add to their growth, and so it certainly kept investors in the game. Let's take a look to see how this economic news relayed into flows for this week. Let's take a look at our macro groups. Macro group equity funds actually took in about $1.8 billion, and we saw taxable bond funds taking $3.3 billion. Muni bond funds saw inflows again of about $600 million, and money market, which have been just whipsawed around over the past several weeks, actually saw one of the most tame flows that we've seen in quite some time, about $72 million in outflows. That was it. Well, as we take a deeper dive and take a look at equity funds, we see there's some different trends that have actually come out. Equity funds were up about 0.5% for the week, and that's the first week in 3 that we've actually seen positive returns for this group. But we saw about $1.8 billion enter the coffers. It's the 21st consecutive week that we've actually seen net inflows. And if we take a look at the domestic side of the equity funds, we saw about $800 million come into their coffers. It's the 4th consecutive week they've seen net inflows. But on the non-domestic side, the party's continued. 22 consecutive weeks, $1 billion in net inflows. And how those broke down is we actually saw people leaving, of course, biotechs, the large growth, health biotech, those type of, but we saw large cap funds on the domestic side taking about $833 million. And then if we take a look at the international side, we saw the developed markets actually do very well, taking in about $931 million in net new money. And then we saw also emerging markets. Again, China news was pretty good. In India, obviously, people are anticipating the BJP party would come back into power. Took in about $200 million. That's probably some of the better flows that we've seen for quite some time on the emerging market side. Well, now let's take a look and transition over to the ETF part of this presentation. And we see for the second week in 3 that we saw inflows, about $7.9 billion. And at the top of the group, we saw the kind of out of favor groups in the last several weeks. So iShares, Russell 2000 saw the biggest inflow, $3.2 billion. We saw the SPY, Spider S&P 500, taking about $2.1 billion. But at the bottom, we saw kind of some unique things. The iShares U.S. Real Estate Fund actually saw outflows about $500 million. I don't know if that really made sense. Some of these, you just can't put anything on, week-to-week noise. But then we saw the iShares S&P 500 Growth Fund actually losing money, about $300 million flow out of their coffers as well. So that certainly was a story, and it kind of matched what we saw on the open-end side as well. Let's take a look at what happened to the fixed income side of the universe. For the 19th consecutive week, we saw inflows, $3.3 billion. It's the 4th consecutive week, though, that we've seen positive returns, 0.31% return. Maybe not to write home about, but again, we're seeing some consistent returns there. What's unique, though, this week is we saw corporate investment-grade debt funds actually take in the most money, $1.8 billion, and they were not helped by loan participation funds. Loan participation funds actually saw about $300 million in net outflows. This is the 4th week in 5 that they've actually suffered outflows as well. But what we did see is investors, again, voting with their feet and letting the portfolio manager do a little bit more work. Flexible portfolio funds actually saw about $700 million net new money come into their coffers, and that was the 19th consecutive week of net inflows for that group. Well, let's take a look now at the ETF side. Very, very mute response here, but we did see $1.1 billion net new money. So we saw a couple of larger ones, as you can see it in this graph, but really as we went down, it was just a lot of black in there, not a lot of red. So at the top of the group was the iShares 20-plus Treasury Bond ETF. That took in about $290 million. But on the bottom side, we saw currency funds and the iBox High Yield Corporate Bond Fund, lose minimal amount of money. The iShares Corporate Bond Fund, iBox High Yield, basically lost about $90 million. Nothing to really write home about at all. Why don't we go ahead now and move on to the muni bond funds? This was actually quite a story. $562 million in net new money coming into that group. Second consecutive week that we've seen inflows, but it's the seventh consecutive week we've seen plus side returns. This time was 50 basis points. Well, we did a little calculation and we saw that our corporate triple B bond funds for the year basically had about a 3.3% return. And then we actually said, hey, how about the muni bond fund group? So how did they do? And the general insured muni bond fund group basically saw about a 3.3% return. So on an after-tax basis, obviously we know that muni bond fund investors are getting a much bigger yield if they take into account the taxes. So certainly this has been a reason why we've seen it. National munis took in the lion's share, about $561 million. Remember I told you it was $562 million as far as inflows. So we saw a little bit of money going to single states. Obviously investors have been pushing their way towards national munis for quite some time as we've been talking about this. Let's take a look at our last group, and that's going to be money market funds. Money market funds for the second week in three saw outflows, but this time it was absolutely minor. $72 million in outflows, and how it broke out is we saw taxable money market funds taking about $755 million, and tax-exempt money market funds hand back $827 million. Well, let's take a little deeper dive, though, just for a second. Institutional funds on the taxable side actually saw about $4.5 billion net new money come into their coffers. However, the retail investor actually redeemed money about $3.7 billion, so it was just a push. Well, what we're looking forward to, and we heard about this morning, is seeing if we can get some better news. Obviously, we've heard a pickup in the housing market. We actually saw April housing starts come in 13.2% up, and that was way, way past analysts' expectations. That was actually some good news. We'll see if that drives the markets. And also, we saw India voted in the BJP party. They're not even done with this. Is Friday afternoon. They're not even done with the elections, but because of the preliminary count, they can see that the Hindu BJP party, which is very business friendly, basically come into power. And I think that may have some good vibrations to the rest of the global economy, especially if it kind of spills over into China and hopefully the United States as well. Well, if you want to do a deeper dive and check out some of the classifications that I've left off, please join us at lipperusfundflows.com. If not, join us next week when one of our analysts will talk to you about flows. And until next time, my name's Tom Rosine, wishing you the best in your wealth planning and creation.